market movers. This is The Pulse.
Good morning and welcome to The Pulse. I'm Lizzie Burden in London. Now this morning we've got stocks and US Treasuries gaining after softer US jobs data strengthened bets on a Federal Reserve rate cut. And with the US government shutdown on track to end soon, investors are bracing for a flood of delayed data once those agencies reopen. To dive deeper into the economic outlook, Rajeev Sibal, senior global economist at Morgan Stanley, I'm pleased to say, joins me now. Great to have you back, Rajeev. So we've got these bets on after the ADP numbers that the Fed is going to cut. If it doesn't cut next month, would it be behind the curve?
I think that it's going to be a tense debate whether or not the Fed cuts. You have a lot of data that's coming out over the next few weeks. Historical precedent from the 2013 shutdown suggests that we will get a lot of the September data in the next week or so. But I think there's a big question whether or not we get the October payrolls data ahead of the FOMC. Our baseline is that it should come out based on the precedent of 2013. But last time the government was not shut down for an entire month. And so there's a lot of question marks about what data was and was not collected. We'll be looking for the BLS, the Bureau of Labor Statistics, to give a little bit of indication on timing after the government reopens. But this is very important for that Fed meeting because ultimately the ADP data is a little bit of a new data series. We've not been tracking ADP data on a weekly basis, and the monthly data from the ADP is not as correlated to the non-farm payrolls as we would expect.
Exactly. I mean, we've had the Wall Street Journal reporting on how split the FOMC is. Of course, the labour market is so much in focus. From the private survey data that you've seen so far, what is your read on the labour market?
So our read is actually that we don't have a change in our NFP forecast. You've seen two different stories come through. The Challenger job cuts was something that caught headlines recently. But
are we overweighting them?
We're not. And if you read the data, a lot of it was talking about the Doge cuts that were coming from government cuts earlier in the year. And so the result of that is that was kind of anticipated, and that was always going to be a drag on the October payroll. The initial claims data looks okay. So we're seeing signals in both directions. And because of the lack of correlation I was talking about with ADP, we've retained kind of our expectation that 50,000 level for the September NFP is going to be what we expect.
Now, we're in November. I have to kind of congratulate you because you were one of the few that didn't see a recession this year. So now we're looking to next year. We're looking for when productivity is really going to take off. And I suppose the big question is when we're going to see the fruits of all this AI capex.
So this is the big debate, I think, in markets. And if we think about AI capex, the challenge is if we, again, look at historical precedent to the 2000 internet introduction in the economy, it took 3 or 4 years for that data to really show up in the economic sphere, if you will. We think this time will be faster, but it's a big debate if we're going to see it in 2026 or 2027. And one of the things we've been writing about is exactly this delay and how investors need to be thinking about it. Because the challenge we think we're going to face over the next 1 or 2 quarters is a lot of the weakness in consumption that was perhaps expected maybe in Q3, perhaps was pushed to Q4 and Q1 because the tariffs didn't really come into effect until August and September.
So how much of a rebound would you be expecting in the US early next year?
So we actually don't really have the rebound until Q2, Q3. We see that you probably have 3 to 4 months of a drag ahead of us. You can see that in our inflation forecasts, a little bit deceleration in consumption. And this is going to be, I think, a little bit of a rude awakening for markets. And then you have the added complication of the government shutdown, which is going to be a drag on GDP data. So over the next few weeks, I think the data that we get is going to be hugely critical in setting expectations for the beginning of the new year. You have markets that are, I think, expecting an acceleration in consumption, but that timing of that acceleration may be delayed for 1, 2 quarters, and that becomes a big challenge, I think.
Okay, really interesting. I also want to turn to Europe because we saw German investor confidence dipping. Does that mean that Germany's fortunes are starting to turn or not yet?
We remain supportive on the German economy. We recently upgraded our German GDP growth by about 10 basis points to 1%. I think the debate on the confidence is really about the timing of the stimulus. We see that a lot of the stimulus early is going to be more on the social side, and the infrastructure projects, which is natural, take a longer to implement. And so some of that benefit may not be immediately visible in the next few quarters or the next few months. And so as a result of that, confidence is probably going to be moving back and forth. But we do think the German economy is well supported into next year and thereafter because of the stimulus.
So then when's the ECB going to cut again?
So we have the ECB cut in March. We do think that euro area as a whole, while Germany is strong, does have drags from French fiscal risk, Italian fiscal risk. And also, as I mentioned in the U.S., if you have a little bit of a slowing of consumption over the next couple of quarters, that could knock on to export data in the euro area. So we do expect that PMIs, even though they've been resilient, could have a little bit of downside risk in the next few months. And if that were to happen, we think that the balance on the ECB would push more towards a cut.
OK. Rajeev, don't go anywhere, because I want to get your view on the UK as well. That's Rajeev Sibal, Senior Global Economist at Morgan Stanley, of course. But let's bring in our Bloomberg Opinion columnist, Rosa Prince, on the latest in the UK. The Health Secretary, Wes Streeting, denying plotting to oust Prime Minister Keir Starmer. This is after Bloomberg learned that allies of Starmer privately accused Streeting of planning to challenge for the Labour leadership. So let's get Rosa Prince's take on all of this. Rosa, why do you think that Starmer's office slapped down this leadership challenge that our political editor Alex Wickham reported so hard right now? Do you think that he wanted to see this gilt market reaction, show it to Wes Streeting and say, I told you, don't come for me?
I don't think they wanted it to be quite this big. I think Downing Street will be quite unhappy about the headlines this morning. Now, the truth is that whenever you talk to a Labour MP, sooner or later, usually sooner, they will start talking about the Prime Minister, how badly he's doing, what they could do to get rid of him. So I think this kind of bubbled up. It reached a peak. And as you say, Bloomberg overnight reporting that the Health Secretary had as many as 50 signatures of the 80 you need to mount a challenge and was therefore ready to go. And Downing Street went very hard on slapping that down. Wes Streeting, however, has come out this morning and denied it. He says, in the terms of that reality TV programme everyone's been watching, The Traitors, he says, I'm a faithful, I would do nothing. It all amounts to a lot of chaos, and I think that's really problematic for the ruling Labour Party, because they came to office promising to end the drama that was really the hallmark of the previous government.
Yeah, he did deny it, but he's also criticising the Prime Minister here. Do you believe Wes Streeting at this point, or do you think the challenges are just going to keep coming?
Yeah, well, look, we have to take him at his word. I think it's certainly true, and I think even Wes Streeting would say that if a vacancy became available, he would want to be in the front line in the job. He would run for it. He's ambitious, he's keen, he doesn't think there's anything wrong with that. What he would deny is overtly plotting to topple the Prime Minister. And I think it's almost a kind of combination of things, which is, one, his own backbenchers are very unhappy. They see those opinion polls and know that they're probably, a lot of them, going to be out of a job if it keeps going like this. And we're Streeting there saying, hiya, if it falls vacant, I'm available. So do the two come together? That's what Downing Street fears.
Well, yeah, because of that polling and Starmer really languishing behind Nigel Farage, the Reform UK leader, a lot of people, young people on the left of the party, have been looking across the pond at Zoran Mamdani and asking who's the Mamdani of Britain. Do we actually need to pay more attention to the Greens and Zach Polanski?
Yeah, this is a big criticism of this Downing Street, that they're so worried about Nigel Farage and Reform UK on the right that they've kind of forgotten about the left. Now, Zach Polanski was elected leader of the Greens in September. Wildly popular, particularly, as you say, with young people. And I think they're starting to sort of recalibrate and realise that perhaps they've made a mistake in ignoring that threat. I don't think the Greens will make a massive difference to Labour. I don't think that they are going to form the next government, but they could really damage some Labour MPs and deliver seats actually to Reform, which is the reverse of what the Labour Party wants to happen. OK, Rosa, thank you so much for all that analysis. And Rosa's latest print is, of course, on the terminal. Just go to OPIN Go for her latest. Our Bloomberg Opinion columnist, Rosa Prince. Now let's see how that Labour leadership challenge could impact the markets. Rajeev Sibal is still with us. I mean, this political instability isn't good for gilts. We're already seeing it today. What do you take on it?
So I think, in general, the budget becomes the focus here. And if they can deliver on the budget, the gilt market will be happy. If there's challenges to the delivery, then the gilt market is going to be raising questions.
Well, that's interesting, because our economists this morning say that the Chancellor, Rachel Reeves, if she can make a bigger fiscal buffer at this budget, even if that's through unpopular tax rises, even if it means that she has to break her manifesto, she could make the 10-year gilt yield fall 50 basis points. That's £6 billion less in terms of debt interest payments that the UK is going to have to pay. Do you agree with that?
So the level is really hard to speculate at this point, but I do think that if you get a big surplus and either through stronger economic growth or through tax policy that enables you to have a nice surplus, it does change the trajectory and the outlook. Because the challenge I think that the UK has had over the past couple of years is that we're in a constant battle of trying to maintain that surplus. And every time the UK thought it had a surplus, it kind of got whittled away. And so I think this is the thing that the markets are focused on, is if you have a structural surplus, which could be designed through tax policy, then there will be more calm in the market and you could see yields coming in.
Well, we're looking at the 10-year gilt yield up 4 basis points at 4.42 this morning, because of that political instability in part, although investors were buying gilts yesterday, we should note. But, of course, what would help the Chancellor is if the Bank of England were to cut rates. And we got the labour market data in yesterday, unemployment at 5%, traders up in their bets for a December rate cut. Do you believe that labour market data? Because the Bank of England's Megan Green says take it with a wheelbarrow full of salt.
Yes, the labour market data in the UK has had revisions and volatility in recent months and quarters. I do think, though, however, our baseline view, we have been a little bit more concerned about the labour market in the UK. So we do see the headline as appropriately from a direction standpoint. We know that PMIs have been actually resilient in the UK, but the labour market has been one area why we at Morgan Stanley have been expecting cuts from the Bank of England, and so this really reaffirms our position.
So you think they're going to cut in December? Okay, that's really interesting, because we've seen the likes of JP Morgan bringing forward their calls from February to December, but you're already there. Do you expect that the budget is going to weigh on growth? Because a lot of people have been talking about a doom loop where growth is down because of the last budget. Are we going to see more of that if the Chancellor raises taxes again?
I think if we have a policy that brings finality to the situation and you can move on, I think the economy can continue to perform. I believe that the global economy is actually doing very well, and it's supporting both the UK and the euro area. And so if the UK can move past the budget crisis, if you will, and think about what is economic output going to be from different types of economic policies rather than just thinking about spending and revenue generation, that it will be more positive for the economy.
And is AI the silver bullet there? Because we started by talking about that CapEx turning into productivity stateside. Do we see a similar picture here in the UK?
So I think, and this is not just the UK story, this is Europe, this is the world in total. We need to see it first in the US because that's where most of the investment has been in AI. And then the adoption can be more rapid in other parts of the world. And so this is why I think not only for the US but for the global economy, what happens in Q1 and Q2 becomes very important from the AI perspective.
Okay, really interesting. Definitely a theme for 2026. Rajeev Sibal, Senior Global Economist at Morgan Stanley, we thank you so much for your insights this morning. Coming up, we're going to check in on the pound after those rumblings of a leadership challenge for the UK Prime Minister Keir Starmer. I'll be speaking to Barclays Global Head of FX Strategy next. This is Bloomberg.
November 26th, Chancellor of the Exchequer Rachel Reeves delivers the UK's autumn budget. Can she boost growth and productivity by unlocking investment? How will the Treasury raise revenue without breaking tax promises? And will the budget prove that a fairer economy can reward working people? Bloomberg Television brings you special coverage starting with the Chancellor's statement to Parliament at 12:30 p.m. UK time. And tune in Thursday for the opening trade budget special at 7 a.m. Bloomberg. Context changes everything.
There's so much disruption in politics, in trade, in blockchain, in AI. How do you think we'll reflect on this period?
I have to tell you that in my 30-plus years in this business, I have never felt the intense pressure of change like we do right now. From an investment person, staying on top of all these things has always been core to what they do.
All right.
Okay.
Gosh, it's like Hogwarts.
Yeah, it's like Hogwarts.
Thank you so much.
Wow.
It's quite impressive being in such a big hall.
I know.
I feel
very
like the weight
important.
of history.
Yes.
Jenny, thank you so much for doing Leaders with us.
I am honored to be here.
So let's start from the beginning. How would you describe your family?
Wow, that's just diving right in.
Let's go in.
How would I describe my family? Look, I think bunch of achievers. You know, you look at my dad, he really built Franklin Templeton. People always say my grandfather started it, but my dad took it over when it was $2.5 million in assets and $10,000 in revenue.
So, Jen, what was the interview process like to becoming chief executive?
So it was not a fait accompli.
Okay.
So the board, you know, look,
that's tough if you're like part of a family.
Oh, trust me. They put me through a Spencer Stuart CEO survey, and they said, we're going to give you a scenario, and you need to answer it. And the only reason I remember this one, I don't remember any other, is because my mind went completely blank with fear.
So that was Francine speaking to the Franklin Templeton CEO, Jenny Johnson. And you can catch more of their conversation in the next episode of Leaders with Francine Lacqua. That premieres at 5:30 p.m. London time on Friday, right here on Bloomberg Television. Now, getting back to these markets, we're looking at the pound weaker 0.2% at $1.31. It's recovered some ground after falling on the back of the worrying UK jobs data. Also factoring in, of course, that UK political instability that we have just been discussing. But we yesterday, of course, had that official data showing that unemployment reached the highest rate since COVID. In a possible bit of relief for the government, economists, though, are raising concerns about the accuracy of that data, including Bank of England's Megan Green. Now, joining me to discuss is Themos Fiotakis, Global Head of FX Strategy and EM Macro Strategy over at Barclays. Good to see you.
Good to see you too.
Let's start on the pound then. So we've had Keir Starmer saying that markets wouldn't be very happy if he were replaced as Prime Minister. What sort of a market reaction do you think we'd see if he were replaced by Wes Streeting, even if Streeting is denying it?
I do think that obviously the market has been quite sensitive to any kind of political noise. What the market wants to see is a reasonable budget that leads you to some kind of path that is credible. And any distraction away from that would weigh either on bonds or on the currency to some degree. And on top of that, you have economic pressures that need addressing. So political noise is not what the market wants to see right now.
What's reasonable? What does reasonable mean? Because I think it's one thing to politics and another thing to the bond market.
Yes, so if you look at it from an economics perspective, the primary deficit is not enormous. It's middle of the pack. And if you compare it to other developed economies, the amount of budget consolidation that needs to be done, a little bit more than 10 billion, is something which is manageable. I think what the market wants to see is that whatever measure is put forward is an efficient measure. So ideally, the market would have liked to have seen some kind of spending cut, but it's not going to see that. At the very least, if tax hikes are being brought forward, credible set of measures that will last, will stick, will have a high yield in terms of budget returns would be welcome from the market.
I mean, is it a blessing for Rachel Reeves that the budget almost coincides with Thanksgiving? Are we going to see less liquidity and that meaning that there could be more extreme moves, or does it mean there'll be fewer cross-currents?
You know, to me, I think everything is so well signaled right now that I don't particularly... I think that something would need to be enormously surprising to see enormous moves. I would be tempted to see it the other way around. The pound is now cheap. There is a risk premium to what is going on. I would wait to see what goes right to start unwinding some of this madness, let's just say, in terms of pound at least.
OK, but what about the Bank of England? Are you expecting a cut in December? Because it didn't sound to me like the Governor, Andrew Bailey, was all that convinced that inflation had peaked.
Yes, I mean, we do have a slightly more dovish kind of approach to the Bank of England. I do think, though, that the pound in itself, when you look at euro sterling, it's at 88. It has been at 89 or 90 during events like Liz Truss or the Boris Johnson negotiation on the post-Brexit future of the UK. So I do think that the market is factoring, and has been factoring this for a while, the economic weakness. I do think that if we go past the budget without enormous surprises, we might see tensions in the markets calm down. OK,
well, I want to stay with the politics, but flip to Japan, because we've seen the yen at a 9-month low against the dollar. 154 per dollar is where we trade right now. We've had the Japanese finance minister coming out and saying that he's keeping an eye on it, but I wonder how weak the yen has to be for you to expect a proper intervention from Tokyo.
I think substantially weaker. The reason here is that First of all, they're looking, when it comes to their reaction function, they're looking at volatility, at size, speed, violence of moves, not particular levels. So we would need to see a fast move to something like 160 or well above 155 for all intents and purposes. But beyond what they would do, I think what is important to keep in mind is that we have gone through a very bearish dollar environment since April, since Liberation Day. We have gone through a period of time where rates in the U.S. have been repriced lower relative to the rest of the world, where the euro has traded at some point 118 and now still at 116 almost. And the yen has not just failed to capitalize, but it's actually trading quite soft and quite weak, which speaks to a weak underlying story, which speaks to a market's lack of confidence for policy normalization in rates, and for a fiscal and political direction which is moving the opposite end in terms of what would need it to happen to get a stronger yen.
Well, Themos, you mentioned the dollar, and that takes me to the political chaos that we're seeing in the US. Potentially an end to the US government shutdown. We were talking before we came on air about how quiet things have been in FX actually recently. Do you think the volatility will come back when and if that shutdown ends?
Good question. I do think we will get some moves because we're going to get less pressure on the economy from the shutdown itself. We're going to get a bunch of data. There will be contradictions. There will be some data that's going to be softer. Some data is going to be stronger. The market's going to try to move. To me, I think all of that is a little bit of a distraction, to be honest. We're focused a lot of when the government will reopen, how long it will stay shut, whether the next couple of payrolls numbers are going to be soft. But when you look ahead, you have an economy that has already benefited a lot from AI spend. And massive companies, enormous companies, the major sort of like tech companies, are promising $3+ trillion of AI capex for the next 5 years, which is an enormous amount of money for any economy, even for the U.S. And I think that is something we will start seeing already by the end of this year, beginning of next year, and it will support the dollar.
OK, because I had to chuckle at your note. You wrote, sometimes the macro world observes developments in the corporate space as if they take place in some parallel universe. So how much of a tailwind is AI capex going to give the dollar?
Well, let me first justify my point. When you speak to the macro world, they'll address what's going on in AI space as some kind of science fiction movie and some kind of equity bubble, which is not. You're talking about companies with proven business models, with enormous free cash flow, with amazing capacity to take loans, telling you that they're going to be absorbing resources globally.
Yeah,
basically.
But you cover EM as well.
Yeah.
So let's say the AI bubble bursts. Which EM currencies are most vulnerable?
I think that, obviously, I don't think that currencies in EM have actually moved because of AI, to be honest. You could see natural resource currencies get hit because of some expectation for demand. But I do think that we haven't seen that theme priced into FX markets here.
Okay, it's interesting. Bank of America pointing to the Thai baht and the Colombian peso, but let's keep an eye when and if that bubble bursts. Themos Fiotakis, thank you so much for joining us, Global Head of FX Strategy and EM Macro Strategy at Barclays. Well, coming up on the programme, is London still the place to be for the global elite? We're going to discuss with Rajaa Mekouar, Senior Advisor at the family office Capnor. That conversation next. This is Bloomberg. Good morning and welcome to The Pulse. I'm Lizzie Burden in London and these are your top stories. Stocks and treasuries gain as signs of a cooling labour market in the US prompt more bets that the Fed will cut rates next month. Here in the UK, the Health Secretary denies plotting to oust Prime Minister Keir Starmer, accusing Downing Street of self-destructive behaviour. Plus, Hon Hai reports better than expected profit and Infineon says it'll return to growth thanks to the global boom in AI spending. Well, those are our top stories this morning. We're also watching the moves in the oil market after that latest report from the International Energy Agency further tempered its stance on an imminent peak in oil demand, reinstating a scenario in which global consumption keeps growing to the middle of the century. Let's get analysis now. Bloomberg's EMEA News Director Will Kennedy joins me for more. Will, just talk us through this report. We're looking at Brent weaker 0.7% at $64 a barrel. How is it likely to be received globally longer term?
Yes, this is their annual long-term report that's produced by the International Energy Agency, and it's been quite controversial over the years. They had done away with what they call their current policy scenario, i.e. if nothing changes, what happens to demand, and gone for scenarios that assumed we would take more drastic action against climate change. The IEA denies this as a response to the Trump administration to reinstate this forecast, but I think clearly it's acknowledgement of the shifting political winds around climate change. And what it says is right now, if current trends continue, far from having a peak in oil and gas consumption that many people had predicted, oil consumption will rise by 13% to the middle of the century, which is not good news for our prospects of tempering carbon emissions.
Well, yeah, just take us through the supply side, because OPEC's been upping its production recently. That's the demand side, but what about supply?
Yep, there's plenty of supply in the world, and I think one of the reasons that oil demand is still rising in the short and medium term is that it's relatively plentiful and relatively cheap, and that means that the shift to electric vehicles, and the IEA was explicit about this, may not be quite as quick as people expected some years ago. Of course, electricity prices are rising in many parts of the world because of the boom in demand from electricity and electrification and artificial intelligence and electric cars. Meanwhile, we have an oversupplied oil market, as you say, and that's keeping the price of gasoline and the diesel that people put in their cars relatively low by historical standards.
All right, Will, thank you so much. Will Kennedy, Bloomberg's EMEA News Director, with that crucial context. Now, London, as a destination for investors and the wealthy, has very much been in the spotlight of late after the Labour government introduced tougher tax rules on the non-dom population last year. The country's once vibrant stock market also in a rut, with a flow of negative headlines weighing on the city's reputation, including this morning ahead of that UK budget later this month. But my next guest says that London still retains huge appeal. That is Rajaa Mekouar, Senior Advisor at the family office Capnor. Good morning to you, Rajaa. I want to get the case for London from you, because we started the show painting a pretty chaotic picture of London, especially when it comes to politics. Why are you so confident in its appeal?
Well, I mean, we should always, nuance things. I think London has a great legacy reputation. It has, used to have great infrastructure. There's a huge pool of capital still in London, and it's the natural, stopover for American investors altogether. But I think slowly but surely, this legacy position is being eroded because of recent political uncertainty. And, even if I look at it from the capital and the wealth standpoint, while this kind of money doesn't move, with a knee-jerk reaction, it also watches where clarity comes from and will follow that. So I don't think it's a blanket approach that we should have, and we should watch the news very carefully. The upcoming budget is super important, and unfortunately we've had some negative signals that worry the investor community. But if you take Brexit, then you add to it the end of the non-dom, the IHT starts to accumulate in a worrying way. And we're just still hoping that the next decisions will be a little bit more favorable to preserving London's role.
Well, yeah. Do you see Rachel Reeves, the UK Chancellor, as a friend to the rich? What sort of measures in the upcoming budget would drive Americans away?
Well, Americans are looking at wider options because of the recent mayoral election. But, again, it's not like you can just bail out of New York overnight. And I think what worries people the most here in London is the mansion tax. It's this new exit tax that has been rumored to be being discussed. And anything that prevents capital from working hard and being optimized, I think, will not please people in our community.
I mean, you mentioned Brexit. Arguably, Brexit's given Britain the freedom to negotiate its own trade deals, free of the shackles of Brussels. We were front of the queue for that trade deal with Washington. I only say this partly in jest, the following. Is the political chaos here in the UK actually something of an attraction for Americans? It seems to have attracted the likes of J.D. Vance and Elon Musk.
Well, no, I don't think so, because I think capital follows clarity, and anything that is not, looking like with good visibility will not help. But at the same time, Europe is seen as a more benign territory now from the US, because it's on a relative basis, it's cheaper. So you see big firms in private equity expanding operations in London. They can buy companies that have, success and issues. They can also hire good talent at a relatively lower cost than in New York. But for New York business, the alternative is not only London or Europe. If they want to move, ranks of staff, they also have other alternatives in other U.S. states. And I think I was just reading the stat that nowadays JP Morgan has more staff in Texas than they do in New York, just because of the cost of living and the salaries, etc., that are become really, really expensive. So, Europe is seen from America as a good turf for better pricing in general.
Well, yeah, what about other European capitals other than London? I think of Milan and all of the active efforts that the Italian government is doing to draw those non-doms away from London and to Milan.
Yes. I mean, the Italians have been great at introducing a flat tax, which wealth loves. At the same time, I think it's too early to call the shots, because if you look at the wider economy, it's not like Italy is growing very fast. Miss Meloni has been good at cleaning up, the deficit. But I think right now, debt to GDP is still 130% in Italy. And all these measures eventually are taken into account. At the same time, if I look at capital and if I look at talent, which are the two notions that I like to oppose, people who have met their money or have money are very easily moving to Milan, but talent that still works and need a career, I don't think have that much prospect in Milan, and London remains an attraction for the younger generation. And I think that's an important nuance to keep in mind.
Yeah, why specifically is London so attractive to the younger generation?
Well, it's the critical mass of infrastructure, opportunities, at least in our industry, private equity in particular. It remains unbeaten. It's very international. It's the natural stopover for Americans. And from that standpoint, the opportunities are still better and bigger in London. But of course, down the line, the cost of living, the ease of living, the quality of schools and the infrastructure around it will also be taken into account. So let's say in financial services, London still remains number one, but it shouldn't rest too much on its laurels and count only on its legacy image to attract talent, because one thing is to attract talent, another one is to retain it over time.
So overall, is it more a London pull or a Trump-Mamdani push, Rajaa?
Yes, I think, again, people are watching. In New York, people are nervous, but so are they in London. The political, chaos right now doesn't help anyone. But I would say that for New Yorkers, London remains a playground that's natural, and they don't have to live here to enjoy the benefits of London. And for people in London, the playground is much wider. In Europe, you have now Dubai emerging as a clear hub for lifestyle. And again, I would keep the separation between those who have to work to make money and those who have money and don't need to work anymore.
OK, really great to have you on. Rajaa Mekouar, Senior Advisor at Capnor. We'll see where those non-doms land in the future. But speaking of big moves across the world when it comes to hiring, major US investment banks are speeding up their hiring of finance specialists in India. The flurry of job postings underscoring Wall Street's growing reliance on Indian hubs. And that reliance is set to grow as President Donald Trump moves to tighten immigration by driving up visa costs. For more, we're joined by Bloomberg's Yapon Janjaron out of Mumbai. Good to have you. Just talk us through why India's global capability centres have become so important for Wall Street banks.
Hi, good morning, Lizzie. Thanks for having me. Global capability centers are what multinational companies are establishing overseas to provide worldwide support for their operations. It used to be a simple stuff like call center or something back offices. But over the years, the involvement of India's global capability centers have evolved. Now, people in India are doing more sophisticated jobs, from artificial intelligence to quant analysis program and auditing and multi-functions. We are seeing banks hiring senior levels, like including managing directors level in India. So India is now the world's largest hub for global capability centers and very significant to US banks.
And so how are President Trump's visa curbs likely to impact these expansion plans by banks in India?
Good question. Even before September, when President Trump announced the visa fee, we already saw hiring spree in India, and that hasn't stopped at all after the announcement. Actually, our sources were telling us that some of the jobs being posted for U.S. are now being diverted or considered for alternative roles in India. Cost is quite significant, and the big pool of talents in India is actually crucial to U.S. operations. So we may see more jobs and coming here.
OK, well, we'll look forward to that. The big take is already on the terminal. It's a fantastic read. I highly recommend it. Bloomberg's Janjarone. We thank you so much for bringing it to us. Now, coming up on the programme, the UK wellness drinks brand Trip says that it's now valued at $300 million, boosted by a star-studded funding round. And we're going to be speaking to the founder and CEO, Olivia Ferdi. That conversation next. This is Bloomberg. Welcome back. Now, Infineon shares are rallying after the firm posted quarterly revenue in line with estimates this morning and said that it sees revenue growth next year due to the boom in AI centres. As you can see, the shares up more than 5% this morning. The German chipmaker's CFO spoke to Bloomberg earlier.
If you look into the revenue development for AI, and for us, AI is powering AI from grid to core, has developed in a very steep way. 2 years ago, it was 250 million revenue. Last fiscal year, more than 700. And as you said, we just raised the guidance for our AI revenue for this year from 1 billion to 1.5. So we are more than doubling in this fiscal year, and it will not end in 26. We expect the addressable market for Infineon for powering the AI data centers in the magnitude of 8 to 12 billion. So it's a significant idiosyncratic growth driver for the company going ahead.
How much precision do you have at the moment in terms of the outlook on that space and in terms of being able to guide investors to what you are going to see next? How much precision do you have there?
Yeah, so first of all, the 8 to 12 is the addressable market. So it would assume 100% market share, which is probably not the most realistic assumption. 1.5 is the revenue we are generating this year. How much visibility is there? Of course, we have a very broad coverage of all major customers, be it cloud providers, be it processor makers, which gives us a great visibility into the business. You also may be aware that we entered into an agreement with Nvidia to cooperate on the development of a total new architecture, which is 800-volt DC-DC. So there's a lot of visibility in what's happening, but of course it is and remains a very dynamic market.
So that's the CFO. Let's get some analysis now with Charles Shum, technology analyst at Bloomberg Intelligence. Charles, you heard Sven Schneider there. What did you make of these earnings from Infineon?
I think the company's guidance is that we expect, given a very prudent guidance, because there's a lot of headwinds that are visible in the short term. For example, the high inventory in the supply chain, and also the slower growth in the EV market. But the thing we have to look into is actually the term prudent, because we are seeing that there's also some silver lining in the longer term. For example, the AI power supply market is actually growing strong. Actually, the company just raised the guidance on this front actually by 750 million dollars for next year. And also we are seeing that they are also still building a very large capacity for the coming demands. So that shows that they have a confidence that there's more growth in this area. So that's one thing. And the other thing is actually is that it's a MCU, the volume shipment. Just in the earnings call that finished a few minutes ago, the management mentioned that they still are confident that the volume can go in a mid-teen. So that's actually also another signal that the confidence there will be more growth than the guidance hint in the coming quarters.
Yeah, I mean, we're also trying to gauge the AI demand story from the Hon Hai results, and they, of course, have posted better than expected quarterly profit. What do you read into that?
Yes, actually, there's also another signal that the AI server demand is very strong. In the past, we worried that when in the transition period, when Nvidia launched the new AI server, there will be some slowdown. But this year, we are expecting something different. So that's why the Hon Hai is still actually accelerating the shipment for the AI server. And also, this is reflecting on their component sales growth. It's very strong, and that's actually a good growth positive factor because it's a component business actually is one of its highest margin business. So that actually supports its gross margin and also operating margin increase in the coming quarters.
Okay, Charles, thanks so much for digging into those numbers for us, watching all the earning calls for us as well. Charles Shum, technology analyst at Bloomberg Intelligence. And you don't want to miss our latest edition of Bloomberg Tech Europe, focusing this time on the defence space and how AI is reshaping that industry. It all starts this Friday at 6:30 a.m. London time, right here on Bloomberg Television. Now, Tom Mackenzie, of course, will be speaking to lots of exciting founders, and we've got one of those right here for you. The drinks brand Trip, having raised $40 million in a funding round, which included investments from lots of celebrities. The company says that the fundraise gives it a $300 million valuation, and I'm pleased to say we're joined now by Olivia Ferdi, co-founder and CEO of Trip. Welcome to the show, Olivia.
Hi.
It's good to have you with us. I wonder, I've had a Trip drink.
Yes.
I don't know if viewers have, so maybe you could explain to them the difference between a CBD drink and an alcoholic beverage.
Definitely. Well, these have no alcohol, no added sugar. They're positioned as a what we call better-for-you beverage. So you might see these drinks in the front of store in a meal deal. You might find them on a menu listed as an alcohol alternative. As we mentioned, a lot of people reach for these instead of alcohol because the fact there's no sugar as well as no alcohol means you're able to have a healthier option instead of those traditional, slightly sweeter options, which can be a bit limiting if you're actually looking for something to drink all evening or all day.
So am I meant to drink it before yoga in the morning or at night before I go out?
Both. Okay. Yeah, we call it an all day, every day. So like I mentioned, there are people grabbing them. I had one on my way here. You could find one in the coffee shop next door.
You offered me one before we came on, but I think we'll have to save it for after.
Yeah, you can have them any time of day because these ingredients, so functional is quite a new and exciting area of soft drinks more generally. It's driving a lot of the growth in soft drinks, and it's things like magnesium, lion's mane, natural extracts from botanicals which help your mind and body adapt to stress. That stress could be physical in a yoga experience, it could be at the office desk, but it's really flexible. That's why they're having such an incredible popularity, because of the breadth of those moments. It's really not restrictive.
But I know that the ASA banned an ad of yours on that claim that the drink reduces stress, right? Have you had any external advice on that? Can you update us on how you're going to navigate future ad claims?
We have a range of ingredients, all of which allow claims about finding moments of calm. It was a single advert on the website, so a single complaint, and actually we're incredibly confident about our ability internationally to continue using these claims in relation to our brilliant profiles and formulas, which are helping tens of millions of people around the world. The mission is to create 1 billion moments of calm, and having sold hundreds of millions of cans already, we're well on our way to achieving that, which is great.
Well, let's talk about it as an alternative to alcohol, because we've been writing a lot about Gen Z giving up booze. I wonder if it is a long-term shift. Are you seeing evidence of that?
Oh, yeah, definitely. You don't hit $100 million in revenue from something niche that's not got tailwinds behind it. We're talking about these macro trends of people reaching for a better-for-you option. That is a healthier choice versus traditional soda. And then when you're thinking about alcohol alternatives, again, people aren't looking to consume necessarily alcohol-free versions of wine or beer or spirits. Gen Z didn't grow up on those sorts of beverages, so they're looking to enjoy taste and experience, and social media has been a huge driving element in those choices, particularly when about a third of Gen Z are completely teetotal, and all other demographics have reduced their alcohol consumption.
Well, look, Olivia, I'm teetotal. Let me ask you something that I asked the Carlsberg CEO.
Okay.
There is a drink that has no calories, no hangover, no cost. It's good morning, noon and night. It's water. Why not drink water?
Well, I think for our hospitality establishments, that's tons of billions of pounds left on the table, and we really need to come together to support that industry, because experience is a big part of why people choose to relax and socialise as well as celebrate. People reach for alcohol to relax. That's not just a solitary moment at home, but allowing the options and the benefits. The alternative to water here is you've got added benefits in these functional drinks. So beyond water, magnesium to help replenish the balance in your mind and body, lion's mane, chamomile, L-theanine. These added ingredients are giving your body supplementation which supports the best balance and health of your mind and body. That is kind of the counter specifically to water, as well as the broader trend about those venues and how we want to support. We don't want to tell teetotalers, just have water, there's nothing for you, you're not included, We want to join them in the celebration, and actually the teetotal person in a social group is typically the one that chooses the venue. I don't know if you would agree, and knowing that there's more than just water, knowing that there's more than just water, I think is important, not to exclude these people from what is an important part of experience.
True. Well, you've certainly convinced lots of celebrities, the likes of Alessandra Ambrosio, Sophie Habu, Joe Jonas. How important is that group of celebrity investors, the combination of fame and money to your strategy?
I think all of these incredible ambassadors came on as customers. They loved the brand, they were consumers of the brand, and we kind of connected over that, and they were so excited about the growth journey and, the raise and how fast we're growing, how fast we're impacting cultural change. They wanted to get involved in a more meaningful way, and to have them as experts speaking to their audience in a very authentic way about something that helps them. They're each experts in their own right, whether it's a pop star looking to de-stress backstage or decompress after a long tour. Joe Jonas is on tour at the moment. Alternatives to alcohol as well as healthier options that they can recommend. Some of those are mothers, they are business women, they are performers. High performance is such a broad term, but to be able to speak authentically to their audience about things that have helped them find balance and that are healthy, how incredible to be able to talk about something that's actually great for you. There's an incredible amplification that we see typically globally on social, because all of these international experts are part of the journey in a meaningful way.
Well, congratulations are in order, because after that funding round, Trip's now the highest value drinks business led by a woman. How are you going to spend that money?
Oh, we're going to be getting closer and closer to the people that are looking for Trip. That in particular is the US. So all of this funding is to amplify existing growth in the US and the opportunity there. It's an enormous market. Our community and the demand we're seeing from that market is something we want to get close to as quickly as possible, because at the moment simply supply isn't meeting demand. So for us it's about producing more beverage. We're doing millions of cans of production a week. It will be millions of cans per day pretty imminently. The working capital for that is important, as well as the logistics and international marketing efforts.
So when and if you do list, will it be New York or London?
We shall see. I'll keep it open-ended for now. For us, we are running the business. It's a family-owned business, and we built this, my husband and I, after a personal experience, and we're incredibly passionate about getting this to as many people and helping so many on their journey of everyday health and well-being. The future, there's a lot of different ways we can look at it. I think what's exciting from the data that we're all seeing, and a lot of strategics are seeing as well, this is so beyond a niche, this is so beyond a trend. This is something much more macro, which people need to pay attention and cater for. You don't want to be that person in the bar or the restaurant that's being told, sorry, tap water's all we have on offer.
Don't you? Okay. Olivia, we can crack a Trip after this.
Yes.
Olivia Ferdi, co-founder and CEO of Trip. So good to have you with me this morning. Thank you so much. Well, Bloomberg's David Riebenstein is going to be having another big conversation for us later. That's with Kevin Hassett, Director of the National Economic Council. Don't miss that at 5:30 p.m. London time. But that does it for The Pulse. Coming up next is Bloomberg Brief. We're going to head to New York. This is Bloomberg.